you're not too big to fail, but you're big enough to take down the system if you do. And you know the old expression, the time to buy is when there's blood in the streets.
Greetings, everybody, and welcome to this new interview series brought to you by Paradigm Press. My name is Sean Ring. I am the editor of The Rude Awakening, and today I have the privilege of interviewing Jim Rickards. Jim is a graduate of Johns Hopkins, University of Penn Law, and NYU Law. He was a lawyer on Wall Street, an investment banker. He successfully negotiated the LTCM deal on behalf of a lot of very upset investors, and he did that very well. He's the author of 6 books, most notably Currency Wars and The New Case for Gold, amongst others. Jim, thank you for joining us, and welcome.
Thank you, Sean. It's great to be with you. A lot of people ask me why I have 2 law degrees. I tell them once is not enough. So the fun keeps coming.
Oh boy, yeah, excellent, excellent. I tried to be a lawyer, then I took one course and thought, I don't think I could read that much, but good for you for doing that. Excellent. Jim, the reason why we have you on, besides just the absolute treasure chest of knowledge that you have, is that you wrote a really excellent article on the banking crisis and how we're not out of this mess yet. It seems that there are a lot of politicians like, oh, it's all over, everything's fine, nothing to see here, almost Chemical Ali mode. If you wouldn't mind, could you take us back to earlier in the year and just explain and reiterate what happened first?
Right. I'll be glad to do that, Sean. And just, I kind of cut to the chase. The banking crisis is not over. The crises don't happen all at once in one day. They emerge, regulators deal with them, the other new investors come in, they go, oh, it's all good, we got this under control. And then there's 2 or 3 months of a quiet period, and then they just pop back up again. It's because they were never fixed in the first place. A lot of people think this all started with Silicon Valley Bank, and that was March 10th, 2023, when the FDIC declared them, well, basically took over, put them into receivership. But that's not quite the right starting date. The day before March 9th, there was another failure. It was Silvergate Bank, not Silicon Valley, but Silvergate. Silvergate failed, basically closed its doors and went bankrupt. And they were an FDIC insured bank. They were a member of the Federal Reserve System. So they weren't some kind of weird, semi-bank or shadow bank or whatever you want to call it. They were a real bank. But they had one foot in the mainstream banking world at the Fed, but they had another foot in the crypto world. And they were actually a portal between crypto and dollars. And you could buy and sell crypto and get dollars. They would credit your account and all that. But when I saw the crypto collapse coming, or not coming, it happened. November 2021, Bitcoin was $69,000. By November 2022, it was down to around $13,000, give or take. So that was a 90+% collapse. And I saw that. I said, well, there's no way this is confined to Bitcoin. And I was right. A lot of crypto exchanges failed. But the question I kept asking myself, is there a danger, and there is a danger, that there'll be contagion from the crypto world to the banking world? That was the question I had, because crypto, it could all go to zero, knock yourself out. But if it goes into the banking world, we got much bigger problems. And it did. And Silvergate was that portal. Okay. Next day, Silicon Valley Bank fails. And the FDIC did a very interesting thing. They did their job. And by that, I mean, they issued a press release. The press release came out at 6 p.m. on Friday, March 10th, 2023. And it said, we are insuring all deposits up to $250,000. That's what we do. But if your deposit is more than that, you're uninsured. We're going to give you what they call a receivership certificate. Hang on to it. We'll get back to you in terms of what it's worth. You can't cash it in. We don't know what it's worth. We will then proceed to sell the assets of the bank, pay off creditors. And if, as and when there's anything left over, we'll distribute that to you on a pro rata basis. But, just hang on. We'll get back to you in terms of what this is worth. Well, it turns out that, of course, this was all known. Just had to look at the data. Silicon Valley Bank only had 3% insured deposits. 97% of the deposits were uninsured, and the amount was approximately $140 billion. And they weren't all like, $2 million A round startups. You had Roku, Cisco, and other names, big Silicon Valley names that had multi-billion-dollar deposits. And for that matter, one of the crypto exchanges had a $3 billion deposit at Silicon Valley Bank. So it wasn't clear that they weren't going to fail. I mean, this was contagion and recontagion, if you want to think of it that way. So what happened over the weekend between March 10th and March 12th? All the crybaby billionaires, Bill Ackman, all these guys, they all go running to the White House saying, "You don't understand what you're doing here. We got 200 startups in Silicon Valley. They all got like 3-5 million. They got payrolls, they got employees, they got rent, they got technology development. You're going to destroy the tech sector if you don't bail this out." And so then on 6 o'clock Sunday, just 48 hours after the first sound. By the way, I should add that going back to the Friday announcement, that actually came out of the Brisbane G20 meeting in 2014. In 2014, Brisbane G20, we were still in the aftermath of the 2008-2009 financial crisis. There was an uproar. Citizens were, pardon my language, they were just pissed off. The taxpayers bailed out the banking system and all the billionaires kept their jobs. So Jamie Dimon, he's still collecting bonuses, Goldman Sachs, all of them. None of them failed. They would have failed, but for the fact that they were all bailed out. But the everyday Americans are like, unemployment's 9%. I lost my job. I lost my 401ks down 50%, et cetera. So there was a political reaction to that. So in Brisbane 2014, they came up with not the bailout theory, but the bail-in theory. And bail-in means that if a bank fails, the investors, the stockholders, the bondholders, the depositors, they have to basically pay off the creditors. They have to pay off the depositors, and only when there's nothing left would the government maybe chip in. So what? And they put the world on notice. The insured amount in Europe is 100,000 euros. U.S. is $250,000. But the whole world was on notice. That's all we cover. Over that, you're on your own. Well, what the FDIC did on Friday was actually consistent with what they all said they were going to do in 2014. It was a bail-in, and if you had $1 billion deposit, you're going to contribute to the rescue. Within 48 hours, they did a 180-degree turn. They completely blew away the $250,000 insurance limit. They said, we're guaranteeing all the deposits, multi-billion-dollar deposits. By the way, a dirty little secret about what happened at the White House. I said that, the Silicon Valley billionaires were all crying about all these little startups and all this stuff. The truth is, a lot of what Silicon Valley Bank was financing was green technology. They were a climate bank. And of course, that's all you have to say to the White House. Hey, this is green. Yeah. And oh, yeah. Now, what were they doing? I don't know, battery technology, better windmills. None of that stuff works, by the way. But no. they were in the White House sweet spot by saying green, and they were. That was actually what they were financing. Everyone thinks, oh, somebody's working on an app. They weren't apps. They were like battery power. So they get bailed out. At the same time, on Sunday night, now we're talking March 12th, they closed another bank, which was Signature Bank. Something about S, Silvergate, Silicon, Signature, all the S's were going down. Now, Signature Bank was another interesting case, which was Barney Frank was on the board of Signature. And if that name rings a bell, just think of Dodd-Frank. Dodd-Frank, 2010, 1,000-page legislation. I know I met Barney. I know Chris Dodd very well. That was supposed to solve all the problems of the 2008-2009 financial crisis, et cetera. Here, the author of the bailout legislation is on the board of the bank, and his bank gets shut down. Well, what's up with that? Well, they had they bought government bonds, and when interest rates went up from 10-year note, treasury note yield to maturity went from 1.75 to 4. All those bonds lost 80% of the value. That's what happens on long duration bonds. Bond math is simple: rates up, price down, vice versa. Well, the rates were up, the price was down, so they were underwater and insolvent, and they got shut down. So Barney Frank's out whining the next day. He's like, "Hey, yeah, but that's true of every bank in the country. There's not a bank out there that didn't load up on treasury bonds at 1.75. They're all underwater. They're all insolvent." And by the way, the Fed announced a facility. They always have these 4 initials. I forget what this one was, BA or whatever. But basically what they said was, if you're a member bank and you have treasury securities, that are where the mark to market value is below par. So you paid 10 million, but they're only worth 8 million. And that was the case across the board. So like a trillion dollars or more of bonds that were in that category. You can deliver them to us and we will lend you for 1 year the face value. So you're putting up 80 cents of collateral, but you're getting a 100-cent loan. I said, I got a 15-year-old car. Will you lend me what I paid for it? Because it's a lot more than it's worth now. But that's what they did. So now my head's spinning. I'm like, well, I get all this stuff, but I'm like, oh, so you just guaranteed every deposit in the banking system without limit, and you just guaranteed every treasury bond at par value without limit. What's left? Like, what else do you have in your bag of tricks? Because you don't have it. There's nothing else you can do. Go back to 2008, they guaranteed every money market fund in the country. So, but here's Barney Frank whining, hey, yeah, my bank was in trouble, but so was every bank in the country. Why did you whack me and give all these guys a pass? Well, the answer is Signature Bank was another crypto bank. It had a portal called Signet. And Signet was a portal to the crypto world. And that's why they whacked it. Notice they whacked 2 crypto banks. So now it's Monday morning, where are we now? The 13th. Everyone's asking Janet Yellen, it's like, wait a second, what just happened? You guaranteed every deposit in the banking system. And she's like, well, no, not really. It's only if you're systemically important. And you're like, okay, could you please define systemically important so we can tell? Because we're getting our money out of all the banks that are not. And the truth is you can't, because the system is so densely interconnected. And this is why they say financial contagion. I mean, it's a metaphor, but actually the mathematics of a viral spread, we just went through a pandemic, but this has been true, for as long as it's been studied. The mathematics of viral contagion are identical to the mathematics of financial contagion. The equations are the same, the way it spreads. And of course, Janet Yellen can't define systemically important. Number one, they try, but they can't. Number two, I don't care how small you are. If you're a small bank and there's a run, the guy across the street, he's getting his money out of that bank. And again, it's like COVID. It's like it just keeps going until the system collapses, which means by definition, just by the dynamics, there's no such thing as a bank that's not systemically important, because they're all connected. Even the little banks are borrowing from the big banks, et cetera. So Janet Yellen hemmed and hawed and didn't have a good answer. She never does. She's not that bright. And so there we are. So the Fed has guaranteed every bond at par value, even if you're worth 20% less. And the FDIC has guaranteed every deposit. And Janet Yellen can't give you a good definition of what's covered and what isn't. Okay. Now a week goes by. What's on tap for the next weekend? Again, Friday night press release, shotgun wedding, Credit Suisse and UBS. Now you're talking to big guys. These are 2 of the biggest, oldest banks in the world. I think Credit Suisse have been around since the 1870s, maybe, and I'm not sure about UBS, but they were the 2 biggest banks in Switzerland. So Credit Suisse fails, and they get taken over by UBS. Okay. And now everyone's like, oh, what's next? Who's next? And there's a list. I'll go through it in a minute. What factors come into play? How can I think about whether a bank is likely to fail or not, regardless of whether they're getting bailed out? And there are 2 metrics that are really good. One is look at the ratio of uninsured deposits to total deposits. If that number is more than 30%, you're a sitting duck. And in Silicon Valley's case, it was 97%. They were 97% uninsured. So a little local bank that's got, I'll say 30% uninsured and 70% insured, they're very unlikely to have a bank run. Most of those customers are like, hey, I'm covered. I'm good. I got 100,000 in the bank. All good. But when you're up at north of 30, certainly north of 50, 70, 80, 90, you're an accident waiting to happen. Yeah. The other metric is total assets. So there really are too big to fail banks. Doesn't mean they can't fail, but it means they're 100% guaranteed to get bailed out. And that list is well known. So who's too big to fail? Like, you can put your money in, they can screw up really badly, and you're not going to get hurt as a depositor. Right. JP Morgan Chase, Wells Fargo, Goldman, the usual suspects, Goldman Sachs, US Bancorp, Capital One, TD, State Street, Citi, B of A, Morgan Stanley, PNC Financial, Bank of New York Mellon, Truist Financial, and BMO Harris. they're the giants. Okay.
Right.
I'm not saying they can't fail. I'm saying that there'll be a safety net put under them, and no one's going to lose anything except
Right.
maybe stockholders, but not bondholders, not depositors.
Positives.
But there's another category where you're bigger than the local savings bank, but you're not too big to fail. You're not on the list of giants. And these are banks with between approximately 100 billion and 400 billion of assets. When you get up closer to $1 trillion of assets, you're in the big leagues. But 100 billion to 400 billion of assets, you're not too big to fail, but you're big enough to take down the system if you do. And these are the ones that are vulnerable, and these are the ones where depositors and stockholders in particular, really need to drill down. I'm not saying, get all your money out tomorrow, but the banks that fit that category that I just described, Citizens Bank, Manufacturers and Traders, Comerica, Webster, East West Bank, First Citizens Bank, City National Bank, not Citibank, but City National, First Horizon, Western Alliance, Valley National, Synovus, Frost Bank, Pinnacle Bank, Cadence Bank, BOK Financial, and South State Bank. That's the list of banks that are big enough to cause a systemic crisis, but not literally too big to fail.
That's not a small list.
No,
that's a lot.
I lost count, but that's like 8, 10, that's like 15, 16
Yeah.
names. But they're all these are, and we, in our newsletters, we occasionally put out recommendations, not all at once, but buy put options on this bank because we think they're shaky. And remember, the stock can go way down, and the bank can still get bailed out. In other words, even if the bank gets bailed out and depositors don't lose money, it doesn't mean your stock can't go from 50 to 10. And that's that's no reason to buy a put option. But the number one bank on that list, going back to now I would say April, was First Republic, and everybody knew they were in trouble. And they got like a $30 billion, I think approximately, kind of a bailout. It was, the usual, again, Goldman Sachs, Morgan Stanley, Citi, a number of other banks on that A list that I described earlier, pitched in like $5 billion each, and they got $30 billion. But that was not capital. That was a loan. So they had liquidity. So you solve the liquidity problem, but you didn't really solve the solvency problem, which is a different issue. But everyone knew that was temporary because they had to pay it back, and how were they going to do it? And all they were really doing, they were propping up the bank long enough so the FDIC could find a buyer.
It was JP, wasn't it?
Yeah, sorry, JP Morgan. You're right. When JP Morgan won it, they got a sweet deal because they wanted the asset management business. They didn't care about the depositors.
Totally.
They wanted the asset management business, which is off balance sheet and recurring. Stock market will give you a 20 multiple on that. And they had to take some loans that might suffer losses, but the FDIC guaranteed the loans. So the downside was protected by the FDIC. The upside is all in Jamie Dimon's, purse. And there you go.
And he got Bear Stearns for a song back in 2008 as well.
Oh yeah,
he's a very good bargain shopper, that Jamie Dimon guy.
Yeah, Bear Stearns, that stock went from like 130, and the bailout number was 2. And then there was a lot of crying, and they said, "Could you give us 8 or something?" So he's finally said yes. So they got $8, give or take. I was like, "Oh, good, the crisis is over." We got through Silicon Valley Bank. The tech startups still have their working capital. First Republic got picked up by JP Morgan. Everyone else on the list seems to be doing fine. Market calmed down. The banking crisis is over. That's the Wall Street Goldilocks soft landing story. All right, let me explain why the banking crisis is not over. And for this, we're going to use a little financial history, which is underrated, but in my view, extremely valuable. Maybe just because I've been around long enough. I'm kind of a magnet for trouble when it comes to this. My first banking crisis was the Herstatt Bank in Germany in 1974. So you got to be, you have to have been around a while to remember that one. That was a foreign exchange. That was a bank where, in those days, if you were in Germany and the U.S. and you were doing foreign exchange trading, and you sold, it was Deutschmarks because it was before the euro. If you sold Deutschmarks for dollars, you would, or bought them rather, they would deliver the Deutschmarks to you in German time, and then you would pay the dollars in New York time. Well,
Right.
they failed in between. They got all the Deutschmarks, but they never paid the dollars because they failed in the middle of the day, and that started a crisis. But anyway, it's a long list since
Yep.
then. But let me point to two in particular, and then I'll come back to 2023.
Mm-hmm.
So the first one I had some at a front row seat, 1997, 1998, the Asia-Russia LTCM financial crisis. Now, what people don't realize, people remember, September 1998, LTCM's about to go under $1.3 trillion in derivatives. That's back when a trillion was real money. But it wasn't, the Fed had no interest in bailing out a hedge fund. I was there, I was their lawyer. We didn't expect a bailout. We're like, why would the Fed bail out us? I mean, it was mostly our money, by the way, so that's why we weren't lynched. But why would the Fed do that? Well, the answer was, it wasn't about us. It was about the 19 banks that were going to fail if we failed, because they're dealers. So if they sell us, $1.3 trillion of derivatives, which they did, they buy them from the other side. Okay.
Yep.
And they're relying on the fact that they have a two-sided position and they make a spread. That's what they do. Well, if one side of the trade goes away, all of a sudden they're net short. They're naked on the other side, and they got to go out and sell stocks like $15 billion worth of stocks to cover the fact that they were long that much on their side of the swap. Well, I can tell you what $15 billion of fire sales stocks will do to the stock market. They would have closed the New York Stock Exchange and a lot else beside. So technically, they were bailing us out. We got $4 billion in cash, put the fire out, brought it in for, foamed the runways, brought it in for a soft landing. But they were really bailing out Wall Street. And we lost the money. Wall Street put in the $4 billion, but then Wall Street owned it. And they got all their money back a year later. But they put out the fire. But here's my point. That didn't start in September 1998. That started in June 1997 in Thailand, when Thailand had a run on the bank. Dollars were leaving the country. They had pegged the Thai baht to the dollar, and people panicked. They said, because money had been going in for resorts and casinos and who knows what else. And everybody wanted their money back, taking the dollars out. The Central Bank of Thailand could not maintain the peg. They imposed capital controls, said no more dollars, and we're going to devalue the baht, which meant for a U.S. investor, all your money was worth a lot less. That then spread to Malaysia, Indonesia, Singapore, pretty quickly spread through Asia. And then it went to Korea. And, the old expression, the time to buy is when there's blood in the streets. Sadly, in Korea, there was blood in the streets. People got killed in financial riots in September, October 1997. But here's the point. It entered a quiet period in December, January, February. Things calmed down, and everyone said it's okay. And by the way, the long-term capital was fine. At the time we were like looking into Asia for investment opportunities. But then it came back in April in a small way, because Sandy Weil was selling. He was merging Citi and Travelers. He owned Solomon, and he told the Solomon guys, "I don't want any volatility in earnings, because I don't want to mess up this deal. So you guys have to reduce your books." But the process of Solomon getting out of swaps widened the spreads. We're sitting there long term, like, hey, spreads are blowing out, buy more. That was the way they thought about things. And then, of course, it came to a head in August. Russia defaulted on their internal debt, their external debt, and devalued the ruble. It was like a trifecta. And then that caused a panic, and then it got worse. And then finally the bailout at the end of September. But my point is, that took a year and almost a year and a half. Yeah. And there was a long quiet period in the middle. So just when you see a crisis evolving and then there's a quiet period, don't assume it's over. It just means that things have been patched up, but it's still percolating below the surface. The second one, of course, the 2007, 2008, 2009 global financial crisis. Now, what happened there? Everyone remembers September 15, 2008, midnight on a Sunday, because you can do it electronically. Lehman Brothers files for bankruptcy. Okay. That started in the spring of 2007. HSBC reported lower than expected earnings because mortgage losses on subprime mortgages were higher than expected. And that's when Bernanke, actually is on the record in the March minutes of the FOMC, said, this will blow over. This will be fine.
I remember it vividly.
Yeah. And then it kind of came to a head in August 2007. That's when Jim Cramer and Aaron Burnett on CNBC goes, they know nothing. They know nothing. And Cramer was right. They actually didn't know anything. But the Fed like cut the discount rate and they cut the Fed funds rate. And then September, you remember all the September '07, Hank Paulson's Treasury Secretary, he announced the Super Civ, special investment vehicle that was going to buy all the credit card receivables from all the banks with government money and then put them into a fund and work them out and all this stuff, which never happened, by the way. It was a dumb idea, but it never happened. But then in December 2007 into January 2008, what happened? The sovereign wealth funds bailed out the U.S. banking system. Abu Dhabi, and they were capped at 10%, but Abu Dhabi bought 10% of Citi, Temasek in Singapore bought, I think, 10% of Morgan Stanley, Kuwait Investment Fund. One by one, those sovereign wealth funds bailed out the U.S. banking system. So January, all good. February, it's all good. What happens in March? Bear Stearns blows up because it wasn't all good. That was the point. By the way, if you ever see a CEO saying it's all good, get your money. Get your money.
That's
fine. Repo's fine. Liquidity's good. We're rolling it over. It's all good. Get your money out then, because it's not that they're lying. It's just that they don't realize how quickly things can change. So then, okay, so March, Bear Stearns blows up. What happens in June? Fannie Mae. What happens in July? Freddie Mac. What happened in August? The Congress passed legislation bailing out Fannie Mae and Freddie Mac. So once again, this is your second quiet period. It's all good. The Congress saved the day. Even though Bear Stearns, Fannie, and Freddie had just blown up, the Congress, in theory, bailed them out. It was all good. And that lasted about a month. And then September, here comes Lehman. So my point is, financial crisis can have one or more quiet periods. In fact, they usually do. Everyone remembers that when the Krakatoa erupted, but they don't know when the shaking began. They forget that these things usually have a year or longer. So if that's the case, and it is the case, I mean, those are just the facts, what should we say about the 2023 banking crisis? Well, we had this, again, March 9th, March 10th, March 12th, March 19th, May 1st, this sequence of failures, big ones, including Credit Suisse. From May to August, we're in the quiet phase. Everyone thinks it's all good. But I've calculated these quiet phases. They last about 3 months, maybe 4. So by that calculation, we should be, now that it's September, we should be at the end of the quiet period getting ready for the second eruption of Krakatoa. So let's put a finer point on that. What are the 8 indicators that the banking crisis is not over and is getting ready to blow? And I'll go through this quickly. Downward sloping yield curves. Now, that yield curve is just the x-axis are the maturities, the y-axis is the interest rates. Yield curves are supposed to be upward sloping. The longer the maturity, the more interest you're supposed to get. If I'm lending to you for 1 month, I want a certain rate. If I'm lending to you for 10 years, I want a higher rate because I'm taking more risk, more bad things can happen. Well, the yield curves are actually going down. What does that mean? It means that the big money, the wholesale money, expects a recession, maybe a financial crisis, and they think interest rates are going to drop like a rock. So why would I take less on my 10-year note than on my 1-month Treasury bill? Well, the answer is I think that 4% on the 10-year Treasury note is going to look pretty sweet when rates hit 2%. So that's what the market is betting. Number 2 is kind of the same thing. There's a downward slope in the SOFR futures curve, SOFR system overnight financing rate. Secured overnight financing rate. It's basically what the euro dollar used to be on the CME, but they got the SOFR thing. But they're downward sloping. Now they're same message. It's a little different contract. These are futures contracts, so you can go out 1 year, 2 years, 3 years. But whereas the Treasury curve is a spot bet on a long-term rate, the SOFR curve is a long-term bet on a spot rate. Now, as you're betting on what you think overnight rates are going to be a year from now. Again, downward sloping, which means the big money says rates are going to be lower. Well, why would they be lower unless you're going to be in a recession? Third one are negative swap spreads. A swap is basically 2 banks or 2 hedge fund and a bank, 2 counterparties basically say, I'll pay you fixed and I'll take floating from you. And, you pay me floating and I'll receive and I'll pay you fixed. So You're basically swapping interest rate. Now, it's the same thing as owning a bond. If I buy a 10-year note in the market, I'm a dealer. How do I finance it? I finance it in the repo market. I finance it in the overnight. So I'm receiving a fixed rate on a 10-year note, and I'm paying an overnight rate in the repo market. Okay. Receiving fixed, paying floating. So all a swap does is like, hey, let's do the same thing, but forget the bond. Like, why do we need the bond? Let's just pay fixed and receive floating, or vice versa, and we'll synthesize the bond holding with one important distinction, which is if I actually own a treasury note and I'm financing it in the overnight market, I'm getting a rate on a government guaranteed security. If I do a swap with you and I'm receiving fixed, you're not government guaranteed. You might be a really good bank, high quality bank. So in theory, I should want a little higher fixed rate from you than I can get from the treasury to compensate me for the credit risk. That's not happening. The fixed leg of the swap, which is bank to bank or bank to hedge fund, that rate is actually lower than the 10-year treasury note. Well,
Right.
why would I take a lower rate from a bank or hedge fund than I can get from the treasury? It's not a credit issue. Nobody thinks that credit is better than the treasury. It's a balance sheet issue. If I do a swap, it's off balance sheet. If I do a treasury, it's on balance sheet. What does that tell you? It tells you the balance sheets are constrained. It tells you the banks are shrinking the balance sheet. It tells you there's a credit contraction. It tells you that there's a shortage of dollars. There's a shortage of collateral. None of these things are good. Treasury bill auction yields are from the Fed are lower than the Fed will give you for a phone call. So the Fed has a reverse repo facility. If you're a dealer, all you have to do is call up and say, I'll give you cash, send me some treasury bills, and pay me interest on the cash. And I'll keep the interest on the treasury bills. And they will for a phone call. Well, but I can also go into the market at auction for the treasury and buy treasury bills at auction. So, but those treasury bill rates at auction are lower than what the Fed will give me for a phone call. So why would I fight competitively to get a rate that's actually lower than what I can get for a phone call? The answer is the treasury bill you get from the Fed cannot be rehypothecated. I have to hold it on my balance sheet. I can't lend it to somebody else. Whereas if I own a bill outright, I can give it to UBS and they can give it to JP Morgan. They can give it to Deutsche Bank. The rehypothecation is the whole chain of leverage in the entire banking system. This is behind the curtain of the Eurodollar market. So the point being, if I'm willing to take a lower rate on a bill that I can pledge than I can get for a phone call, it tells you that there's a collateral shortage. It tells you that I'm desperate to get my hands on that treasury bill that I can pledge because there's not enough collateral to go around. The strong dollar, everyone's like, the BRICS are taking over, the dollar is falling apart, debt to GDP ratio is 130%, the US is going broke, forget the dollar. Really? Well, why is the yen crashing? Why is the euro crashing? Why is sterling crashing? Why is the yuan? They're fighting desperately to keep it above 780. Why is the dollar getting stronger against every major currency in the world if the dollar is the currency of a country that's going bankrupt? The answer is there's a dollar shortage that, believe it or not, for all the money the Fed printed, the amount of leverage in the system is 100 times that. So, so it goes back to collateral shortage, bill shortage, dollar shortage, shrinking balance sheets, liquidity. There's a whole global liquidity financial crisis coming. At the same time, there's this whole recession coming. And we haven't talked about the recession, but those are the rest of my issues. Declining macros and world trade shrinking. That hasn't happened since the Great Depression. Industrial outputs declining, rising inventory to sales ratios. That means the warehouses are full. They can't sell the stuff. And then finally, icing on the cake, massively increasing losses in commercial real estate. So these are all hard data points that speak recession and global financial crisis and tell me that this banking crisis is not over. So hopefully that's all helpful, Sean. I'll toss it back to you.
Jim, that was absolutely brilliant. You think the dollar is actually going to keep going north then? Yes. Okay, good. Because I'm with you on that because I live in Europe and I can't understand why anybody would want a euro. So that's where I'm coming from.
Yeah, the euro's going down, but kind of holding its own. But the currencies that are really crashing fast are sterling, yen, Chinese yuan, some of the emerging market currencies, but then the euro will join them in the end.
Wonderful. Jim, thank you so much for this. I appreciate it. I know it's Friday and it is aperitivo time. I hope you enjoy your Aperol Spritz. And thank you so much for this. I hope I'll talk to you again soon.
Thanks, Sean.